Amid concerns over the U.S. fiscal deficit and persistently high long-term yields, the upcoming maturity of $9 trillion in debt is a key monitorable. This challenge is amplified by potential shifts in foreign demand, as rising domestic yields in Japan and China's reserve diversification towards gold may signal a weaker appetite for U.S. treasuries from key historic buyers. Dollar index has softened by approx 10% from the highs. In the past, softer and stable dollar index has been positive for emerging markets like India in terms of foreign inflows. Resumption of FII's inflows in India during the last 3 months also validates the same. Q for FY25 GDP growth has surprised on the upside, printing the highest reading of 7.4% in the last 4 quarters, while inflation has been softening, coming below 4% for 4 consecutive months. Increased tax exemption limits announced in the budget have come into effect from April 2025, and is likely to boost disposable income and consumption demand across income brackets. On the infrastructure and public investment front, government capital expenditure is witnessing strong year-on-year growth, helping to drive the investment cycle. Meanwhile, the RBI has front-loaded its rate cuts with 50 bps move in the June policy and also announced a CRR reduction, effective September 2025, reinforcing its pro-growth intent. Regulatory support is also visible, with relaxed lending norms enabling easier access to credit, especially for MSMEs and underserved segments. All these measures are expected to accelerate gross fixed capital formation, GFCF, and provide momentum to re-leveraging. Rally in the global equity markets, coupled with pro-growth boost on the domestic front, both at fiscal and monetary side, and healthier macros have led to a risk-on sentiment. Temperature gauge index is trading in the fair value zone. After a volatile beginning of April and May due to tariff concerns and India-Pakistan military conflicts respectively, later half of these months saw recovery in the market as tariffs impositions got postponed while ceasefire was announced. On the global side, while concerns over US debt maturity remains, weakness in dollar index due to this can be considered positive from FII flows in emerging markets like India. Global equity markets continued the up move as MSCI World made new all-time high. The pendulum has swung completely on the other side from risk-off to risk-on mode. Domestic macros are showing uptrend in terms of pickup in GDP, cooling inflation and rising GST collection, etc. From fiscal, monetary and regulatory perspective, things are also looking supportive for growth with higher tax exemption limit coming into effect, government capex showing strong year-on-year growth, RBI front-loading the rate cuts and relaxing the norms for lending. This optimism is also being reflected in the flows from FIIs in India, which have been positive for 3rd consecutive month. However, valuations have increased again as earnings lagged. Nifty 50 is trading above its 1-year forward average, while mid- and small-cap valuations still trade at a premium. Stock selection remains the key in the broader market. Equity portfolio allocation stance remains neutral, i.e. 65% allocation to large caps and 35% allocation to mid and small caps. Investment strategy: investors underallocated to equities may consider lump sum investments in large cap, hybrid and flexi cap funds at current levels. For mid and small cap segments, a staggered SIP/STP approach is prudent given elevated valuations and higher volatility. RBI's actions on rate cuts and liquidity infusion have resulted into a steepening of the yield curve. Longer end seems to be already factoring in the positives of lower inflation and OMO purchase and hence have not reacted much to the recent cuts. Proactive measures by RBI on policy easing and liquidity are likely to result into steepening of the yield curve. Hence, in our view, one may be overweight on accrual strategies across the credit spectrum. Due to limited room for further capital gains, softening of the yield should be used as an opportunity to gradually reduce the exposure from duration strategies. Accrual can be played across the credit spectrum by allocating 45% to 55% of the portfolio to performing credit and private credit strategies, in VEETs and select NCDs. 30% to 35% may be invested in performing credit strategies, NCDs and in VEETs. 20% to 25% may be invested in private credit including real estate, infrastructure strategies and select NCDs. 25% to 35% of the portfolio may be invested in arbitrage funds, minimum 3 months holding period, floating rate funds, 9 to 12 months holding period, and absolute return long-short strategies, minimum 12 to 15 months holding period. For tax-efficient fixed income alternative solutions, 20% to 25% of the portfolio may be allocated in conservative equity savings funds, minimum 3 years holding period. We continue to maintain neutral stance on the gold from portfolio allocation. Any further directional move on gold will depend on the outcome of US debt situation. Silver can be considered for a tactical play on industrial demand recovery and momentum in commodities, but not as a substitute of gold.